Hi, folks. Rick Wedell here. I'm the Chief Investment Officer at RFG Advisory in Birmingham, and I thought given today's market action, I would reach out with a brief economic update. Today is February 24th, and markets here in the United States are off about 3.5%, depending on which major index you want to look at. And the reason why they're selling off is largely due to the coronavirus. So over the weekend, we saw the appearance of clusters of the virus in places outside of mainland China for the first time, notably Italy, South Korea, and Iran. And this is raising concerns that the virus, which had been largely concentrated and contained in mainland China, may be starting to spread a little bit more rapidly around the globe. Before we talk about the economic impacts, I'd like to talk a little bit about the virus itself, just for those of you who dispel a few myths and just for anybody who hasn't been reading on it online. The virus appears to be very similar to a particularly nasty strain of the flu. It spreads relatively easily from person to person. You can spread it without being symptomatic. And the mortality rate is actually quite comparable to the flu, maybe a little bit higher. It's estimated at about 2%. Just like the flu, the people that have the most difficulty with the virus tend to be the elderly or those that have any type of pre-existing medical condition. And just like the flu, if you listen to the CDC, they would say that the best ways to prevent contracting the virus are to wash your hands frequently and to avoid touching your face and mouth. In fact, it's kind of the flu analogy or parallel is actually quite on point, given that if you talk to the CDC, once again, they would tell you that the flu is a much more dangerous pathogen for people who are living in the United States currently than the coronavirus kind of ever thought about being. And so this sort of raises my new favorite saying around, which is if you didn't take the time to go get a flu shot this year, but you're nervous about the coronavirus, you might want to reevaluate your priorities. If we think about the economic impact of the coronavirus, the concern that the markets have is largely around one of a supply side shock. So if you think about what went on in China, if you think about what's starting to happen in Italy and a couple of the other places around the world where the virus has popped up, the markets basically shut down. And I don't mean the markets as in the financial markets, I mean the markets as in the economic markets. So factories shut down, shops shut down, coffee shops, restaurants, all of those types of places shut down. And as I'm sure you can understand, if those places stay shut down for a week, 2 weeks, 3 weeks, or 4 weeks while they work to contain the illness, that's 3 or 4 weeks of demand or economic activity that you don't necessarily get back. On the one hand, you can paint a rosy side and say that the markets are very forward-looking. And so long as this is a one-time event, so long as the demand reappears in the second quarter or the third quarter as the weather starts to warm up and presumably the virus activity starts to go down, then the markets will just roll on through it as if the fourth quarter was a one-time event that we don't need to put into our multiples. If, on the other hand, the economic disruption in the first quarter is so severe that it pushed us globally into a recession, then that would be something that we would have to deal with as we start to see demand rebound in the second quarter and third quarter. So really a little bit too soon to tell, certainly not a time to panic. If you have any questions about any of this, please feel free to reach out to me or directly to your advisor, and I hope you have a great day. Thanks.